Welcome to Capital Insights. Before we get started today, on behalf of the entire team at Capital Planning Advisors, I'd just like to wish you and your family a very wonderful holiday season ahead. Today I'd like to talk about the issue of deflation. It's probably a word we haven't heard in many, many years. In fact, if we roll the clock back about a decade, maybe a little bit more, before he became Fed chairman, Ben Bernanke wrote a piece that was widely read and very widely recognized, and it was called Deflation. It can't happen here. What Bernanke was laying out in the piece that he'd written was that if ever the United States got into a very meaningful downturn where prices ultimately contracted, prices in the economy, that what the Federal Reserve would do, he called it a technology, a printing press, that they would print money. Well, little did we know that about 5 or 6 years after Bernanke wrote this, not only would that piece be the blueprint for the Federal Reserve itself in terms of money printing to lift us out of the Great Recession of 2008 and 2009, but it would also become the blueprint for central bankers globally. Since 2009, the Federal Reserve has printed up about $4 trillion, all in order to stimulate the U.S. economy. But their global central banking brethren, collective with the Fed, have printed up about $13 trillion. That's a lot of money. In addition, governments globally have borrowed. You already know, because we've discussed this in the past, that U.S. government debt has doubled, about another $8.5 trillion. But collectively, governments globally have borrowed about another $30 trillion. So when we put together the government borrowing plus the central bank money printing, we're looking at about $45 trillion. That's a lot. And academically, printing money is debasing the currency. And again, academically, it's inflationary, not deflationary. And this was the exact premise of Bernanke's talk at that time, way back, almost 15 years ago. So let's fast forward to today. It's a word we haven't heard much, deflation. Is deflation still a concern? Well, the fact is, it is still a concern. And it's something that we need to think about and incorporate into investment decision-making as we move forward. Again, a lot of money printed over the last 6 years by the central bankers. But what has it done, if you will, to move that needle of inflation? And it's important because one of the premises behind money printing was that we could theoretically pay down a lot of that big debt load we had back in 2007 and 2008 with inflated dollars. How's all this worked out? Where are we today? Is deflation still a concern? And if it is, what does it mean for our investing activities as we move forward? Let's look at some direct evidence. Let's look at some economic statistics. The chart you're looking at right now is the year-over-year rate of change in the U.S. CPI, the Consumer Price Index. A controversial number, we understand, but what we're seeing here is that we're looking at a year-over-year rate of change in inflation, in CPI, in the United States that's much nearer a 6-decade low than not. That doesn't say that what the Fed has done and the central bankers have done have engendered a lot of inflation at all. It just so happens that the Fed's, if you will, most important to them inflationary gauge is called the Personal Consumption Expenditures Deflator. What does that really mean in English? Well, what it really means in English is consumer prices. That PCE deflator, like the CPI, on a year-over-year rate of change basis, is also pushing a 6-decade low. We're looking at this chart right now. And again, this is the Fed's favorite, if you will, indicator of inflation. And it's telling us, one more time, just like the CPI, a lot of this money printing, not only domestically but globally, hasn't really been able to move that inflationary needle. Incredibly enough, and we'll talk about this more in just a minute, a lot of central bankers recently have actually been targeting inflation rates. They want certain inflation rates to be achieved. This is really a bookend relative to where we were in the late 1970s, early 1980s, where the central bankers were trying to crush inflation. Now they're trying to create it. One of the indicators in the market that we always look at, and it's really a market-based indicator of future inflation, is called the TIPS implied break-even inflation rate. Again, what does this mean in English? Let me try to describe it for you. A number of years ago, the United States started issuing what are called TIPS, Treasury Inflation Protected Securities, meaning if inflation went up over time, you would get an extra little added rate of return to compensate for that inflation. In fact, what's the difference between a 5-year U.S. Treasury yield and a TIPS, a Treasury Inflation Protected Yield? Well, the difference is in a TIP, you get a little bit of return and you get the rate of inflation every year as your total investment rate of return. In a regular Treasury, you just get the coupon income. No, if you will, incorporation of inflation rates at all. So as we look at these two, if we take a 5-year U.S. Treasury yield and we subtract the TIPS yield, same present 5-year piece of paper, what we get is the implied forward inflation rate. Let's look at a chart right now that is the difference between the current 5-year U.S. Treasury yield and that 5-year TIPS yield. What it's telling us is that for the forward 5-year period, the market right now is anticipating inflation at about 1.3% per year. In fact, even more so. Take a look at the whole chart. The forward inflation expectations in the market today are no higher than they were at the end of 2009, when deflation was a concern, when central bankers were printing money. And in essence, what this implies is that all of the printing, all of the money printing by the Fed over the last 5 to 6 years hasn't been able to increase inflation expectations at all. Not at all. And we're seeing the same thing as we look across the globe. The actions of the central bankers recently are also telling us, if we listen, that deflation is a concern. When we had the stock market downturn in October of this year, the very bottom, the day of the bottom, was marked by 3 events. 1, the European Central Bank came out and said they'd print money within days and start buying bonds. Number 2, China did a $32 billion one-day stimulus package. This was 4 weeks after they did a $100 billion one-day stimulus package. And on that same day, we had one of the members of the Fed come out and tell us that they would do QE4 if things got bad. They hadn't even finished QE3. So the central bankers are telling us they're very, very scared of deflation. They do not want stock prices falling. That would be, if you will, a symbol that prices are falling, deflationary pressures are rising. They want to stop that. So what it really tells us is they're still very scared of deflation. About 2.5 weeks ago, we had an announcement out of Japan. It's, again, a new money printing exercise by the Bank of Japan, but it will now be the largest money printing exercise ever seen in the history of mankind. Larger than anything the Fed has ever done. In fact, if it was a Fed equivalency, it was very much like what the Fed had done in the United States on a proportional basis, the printing of money relative to the size of the economy, Japan would be printing $3 trillion a year if it was, again, on a ratio basis relative to the US. It's a lot. But what it says is, again, after 20 plus years of keeping rates low and printing money, Japanese officials are as scared of deflation today as they ever have been. And maybe they have a right to be, because recently we got the second negative quarterly reading in GDP in Japan, 2 in a row. Academically, they're in recession. Likewise, we're seeing the same thing out of the European Central Bank. In early December, they're going to make a decision on money printing. Why is deflation still an issue? Deflation is still an issue because really throughout the planet, debt levels haven't gone down that much. Let's take a look at one more chart. This is total credit market debt in the United States relative to GDP. And as you can see, debt levels have come down a little bit here, but not much. Not relative to where we were over the last few decades. The debt overhang is still big, and that's relatively deflationary. The second issue is this. Accompanying all of the government borrowing and a lot of the money printing has been increases in taxation really across the planet. We've seen it in Japan. We've seen it in the United States. We're seeing it in Europe. Whenever taxes are increased, it's academically deflationary for individual economies that are out there. So still, this is adding also to some of these deflationary overtones. And then lastly, we have definitive economic slowing in China. And it's very important because the emerging markets, all of the, if you will, Brazils and Indonesias and Malaysias, etc., they have been big exporters to China. So when China slows down, their economies slow down. And again, it's deflationary. So although we step back over these last X years and a lot of money has been printed by the central banks, deflation is still a reality. One last comment as we finish today, and that is, we happen to be filming this on the day that OPEC has met. You know that over the last 2 months or so, The price of oil has fallen from $100 to roughly $70. And today, OPEC said that they would not, if you will, shut in any type of oil production to try to get prices up. The declining oil price is also a deflationary symbol relative to the global economy itself. Yes, we have fracking in the U.S. adding to supply over time. Do the Saudis really want to take some of that out, if you will, or put pressure on them? Maybe. But oil declining is a deflationary symbol. Deflation today is still a reality. It may be a hidden reality, but it's one we need to deal with. Finally, in terms of our investment activities, what does this mean and what are we doing? In deflationary environments, assets that provide sustainable streams and growing streams of cash flow over time are very highly valued or are very sought after, if you will. So we're very much looking at creating sustainable streams of long-term cash flow. That's very much a hedge against any kind of future deflationary issues that may be out there. Secondly, we want to make sure that we are very, very sensitive to those companies that are asset dependent. And what I mean by that is, think of a bank. A bank makes a loan against an asset. Well, that asset's price is very meaningful, in terms of backstopping that loan. So we want to make sure also that we're being very, very sensitive to any companies that are very asset sensitive themselves. In a deflationary environment, they may run into a little bit of trouble. So this is very, very meaningful in terms of investment decision making, in terms of forward thinking, etc. And then lastly, we just need to keep our eyes on what happens with the general level of prices. One of the questions at the end of QE3 was, will the Fed start QE4? And the answer for now is no, they will not. But if there are any types of increased deflationary pressures from here, that may not be something that we can count on. They may come back and do it one more time. So for now, deflation is not something we hear talked about in the mainstream press, but it is something that we very much need to keep our eyes on, not only in the US, but globally. The central banker actions recently are telling us this is a reality. We need to listen. Thanks so much for your time in being with us today. We very much appreciate it. Again, on behalf of the entire team at Capital Planning Advisors, our very best to you and your family for the holidays that lie ahead. We wish you health, happiness, prosperity, necessarily in that order. Thank you so much for being with us.